And welcome back, folks. Let's see here. We got to get this camera right. No, wrong way, wrong way. Here we go. U.S. Home Talk, folks. We are back and we're live as we are every Wednesday at noon. Jason Walgrave here with Walgrave Real Estate Group and the Minnesota Real Estate Team. We've got Mortgage Michael Overson with Illuminate Home Loans. We've got back in studio Jerrad Havins with Credilife. Of course, we've got our great producer, Evan, who is not only our radio producer, but our insurance guru. And so, folks, we got a big show planned this morning. We're going to be talking about credit. As we know, credit is one of the most important things to have managed in our lives. It controls so many aspects of our financial world. And today, Jerrad's going to be talking about how to achieve the best credit score that you can, how to have excellent credit, how to have a score that delivers you the most options when you're seeking financing, whether that's mortgage financing, you're looking for a car loan, a personal loan, or you're looking for a job. A high credit score will help in all those areas. Jerrad's going to go through some different ways and techniques and some things that we can do to make sure that we have the best credit score possible, which will then in turn lead to the most and best financial and loan and mortgage options that are out there. So looking forward to it. Evan, he helped get my new podcasting station set up this morning. So Evan, thank you for that. I appreciate it. Jerrad, you're looking good as ever.
Thank you.
You're looking good. Looks like you're shedding some LBs. I know you've been working out hard and eating healthy.
I am. I got to keep going though. I've lost 20 pounds and I need to lose 20 more. So got to keep it going.
Hey, just Jerrad knows the secret. Losing weight is just like having good credit, right? It's consistency.
Yeah, exactly.
Right? You can't just do the right things for a short amount of time, right? And expect the results that you want to get. Same thing with credit repair. It's consistency. Yep. Build the right habits, right? Build the right habits, get in a good spot credit-wise, and those good habits will keep you there, just like being healthy. Build those good habits, keep those good habits going. That will keep you where you want to be on your physical side of things.
Exactly. Yeah, I love that.
It's so true. Consistency. We, Mike, you had me on an agent panel a couple of weeks ago, and there's 100 agents in the room, and they had questions about real estate and how to be successful, and what to do, and that there's no secret, right? I mean, it's consistently working hard, prospecting, working the plan that you have in place, the plan that will lead you to your goals. But consistency is key. And it's really key in all areas of life, right? Whether you're talking about your health or your fitness or your credit score or the business that you want to build, you have to be consistent and you have to have a plan on how to get there. Jerrad today is going to share with us some ways to get to that goal of having a great and exceptional credit score. Mike will talk about what that means on the mortgage side. And of course, we welcome all questions and comments. You can send those through the comment section on Facebook. Of course, we're on Facebook Live and YouTube Live every Wednesday at noon. You can find us anytime via the podcasting platforms, and we're on all the major ones. We're continuing to add more and more podcasting platforms every single week. So we appreciate however you're tuning in, whether it is live or whether it's later in the week. We want to make sure that we deliver the most current, up-to-date information on real estate, mortgage financing, credit, insurance, anything and everything real estate related. So we do appreciate everyone that tunes in. We've been doing this a long time. We kid around and say it's been 85 years and 50,000 shows, but we're at 14 years. 14 years we've been doing this. We've either been on the radio or now on our podcast. So we appreciate however it is that you tune in. We do have a text line. You can text in your questions during the show. That number is 612-234-7585. That is the text line. It's also our 24-hour real estate hotline number. So you can call that number anytime. We will connect you directly with all of our fantastic partners. And again, feel free to text us your questions during the show. Today's topic, how to build an excellent credit score. Any questions related to credit, how it works, how to build your credit, how to repair your credit, how to improve. Any of those things, we'd love to hear from you. The text line to text in your questions is 612-234-7585. Again, that number is 612-234-7585. You can connect with us 24 hours a day at that number, or check out our website, which is ushometalk.com. We're pretty excited. We're going to be launching a new website here. It's almost finished being built, so that'll be launched here in the next couple weeks. So excited to share that as well. But before we get started, Jerrad, tell us a little bit about you and your company and kind of some background, and then we can jump right into topic.
Yeah, no, that sounds good. One thing I was thinking about when you brought up how long you guys have been doing this show, when's the first time that I was on the show? Has it been like around 8 years ago now, you think?
Oh yeah, it's been 8 years. Yeah,
maybe even longer. I remember the first time you invited me on the show, and that's when you were doing the early morning slot, and I was so nervous. I couldn't even sleep that night. Like, I literally did not sleep. I didn't want to miss my alarm. I wanted to make sure I was fresh. And yeah, I mean, it's been really fun working with both you and Mike and being on the show, and I really appreciate it. And I always get excited to be on the show. So once again, thank you for having me on. And for everyone listening, I'm Jerrad Havins, financial freedom strategist and CEO of Credilife, and recently rolled out another division called Credit Biz, where we serve business owners and entrepreneurs. And really, our mission and goal is to empower people to improve their overall credit and financial position. That's what we do every single day. And a lot of our clients that we serve, typically their main goal, they want to buy a home. That's a big one for them, right? And so I would say that we really have a niche process around that. In fact, we actually have a program at Credilife called the Mortgage Readiness Program, where the whole goal around the program is to not only help you repair your credit if that's needed, anything that's happened in your past weighing you down, we can fix that, we can repair that. But then in addition, really working with you and coaching you throughout the process on how to effectively build your credit to improve scores, how to manage your debt in a way not only to improve credit scores, but also put your credit profile in a better position for the mortgage underwriting. So there's a lot of really cool things that we do there. And one thing I've been talking a lot about lately is I'm on a mission. And my mission is to serve at least 2 out of 10 people in the United States in some form or fashion. And that's a big reason why I entered into the business world working with business owners, is because if you think about it, when you empower a business owner to not only improve their credit and financial position, that automatically extends to their employees. They have more, stability in that, the growth of that company. And so everything that I'm doing every single day is I'm looking to empower and serve as many people as possible and just better their overall, their life and their credit. So it's really exciting stuff.
Jerrad, I'll tell you what, a goal of 2 out of every 10, that's only 60 million people.
I know. I mean, it's a big goal.
I love big goals. So good for you, man.
I'll have to have you guys stop by the office, because on the whiteboard out here, I actually have it written out how I'm going to accomplish that. And so, yeah, it's a big goal. It doesn't mean I have to work with every single one individually, but it's through this work and how it spreads, the positive effect of that throughout the nation. And I believe too, you guys know, when it comes to what's happening in our economy, and there's a lot of positive, there's also some negative, but I feel like the education around credit and how to manage your money, just having more awareness of how to leverage credit, improve it, how to save money, how to manage your debt. This is, to me right now, it's the most important time than ever to really kind of lock that in for people. And so that's a big thing for me.
I love it. Awesome. All right. Thank you for a little info about you and your company, Jerrad. You're good. I was thinking back, I think it's been close to a decade. I mean, you said 8 years, but I'm thinking it's closer to a decade.
Yeah, probably.
And I think about the first show that Mike and I did, which was on WCCO. We had we didn't even have to host it. We had Denny Long was the host, and so he ran the whole show. And man, I was so nervous for that show. I don't think I slept either the night before, and I just remember like sweating profusely during the whole show. And it was And again, we didn't have to host it. Denny did all the hosting, but and Jerrad, my goodness, you've come a long way. You've turned into a nationally awarded and recognized speaker. You travel the nation speaking to thousands of people, real estate agents and consumers and mortgage professionals. You're on the big stage. I've seen your stuff. It is awesome. I love seeing you up there. The message and the information and the service that you're providing is so valuable, and it's so helpful. And it's fun to kind of look back and see the journey from there to where we're at now. And you've just done a remarkable job. So nice work.
Yeah. Thank you. And just like we talked about earlier in the show, it really is that consistency piece, right?
Mm-hmm.
That we're talking about, like when you were on the panel and people talking about like, how did you get to where you're at, Jason and Mike, and your work ethic and, all that. And it really is consistency. And
Mm-hmm.
I also believe too, it's, it's almost conquering fears, right? There are times that you feel a little bit stressed. You feel like, I don't know if I can do this. Am I good enough? Like these are things that people face every single day. And I just, it's one of those things that once you break out of that shell and you're
Mm-hmm.
willing to kind of take that leap, right? As long as you're consistent and don't allow failures to have you stop, right? You got to fail to succeed. That's where the magic happens, right? And as long as you're pursuing something that fulfills you, and that's why I love what I do, because you're empowering people. It's so positive. Like there is nothing negative about what I do. There's nothing negative what we do collectively as a team here. So it's like, I think that motivates you even further, right? So it's just really cool. I hope anyone listening, 10 years ago, I was just getting started, and look at all of us now, right? So it's, if I can do it, you can do it. So.
So go ahead, Mike.
I was gonna say, if you look back 10 years ago when we started doing radio shows and podcasts and stuff like that, well, podcasts not back then, but radio show, I'm looking at it and like, we can tell who's got the most stressful job, or at least stressful job out of all three of us. Because 10 years ago, when this started, we all had the same hair color, and we all actually had hair too, right? So now look at mine. I mean, I got to keep mine short so it looks blonde, but it's all gray through here.
Yep.
Jerrad doesn't even have hair anymore.
It's gone.
Here's Walgrave. That doesn't look like he's aged a day since we first started this thing. I'm thinking I got to get in this real estate biz because dang, it's easy street over there.
Oh my goodness, I love it. I even have the gray right here.
Yeah,
graying out.
I mean, not a fleck of gray in Walgrave. Not a fleck. I can't even see. I can't see nothing.
There's a couple in there. There's a couple in there.
Oh,
they say that gray is the wisdom, is the color of wisdom, Overson.
Yes.
So that just it goes to show how smart you are.
Oh, okay. You know what? I'll take that then. If that's the reason, if that's the reason, if that's the whole reason for
wisdom,
this, then okay, I'm fine with it. Then I'm good.
So Jerrad, someone is let's say they want to buy a home, or they want to purchase a car, they want to get some type of financing in place. What do they do? What is kind of their first step in building or making sure that they have a high credit score?
Yeah. The best way I can explain it, with us when we're working with clients and they reach out to have like a consultation, right? A lot of times what we're doing, my team and I, when we're talking with someone, kind of going through the process, is really identifying their starting point right now when it comes to their credit.
Mm-hmm.
And, and it's important, you have to have awareness. One question that we ask a lot is, when's the last time you looked at your credit report? And you'd be surprised. A lot of people are like, oh man, it's been years. I really haven't looked at it. They might see their scores on some apps and things like that. But, when's the last time you actually looked at your credit report, the details within the report itself, right? And what we're looking at there is we need to identify a few things. One, we need to identify if there's anything that's negative weighing down the score. So that could be some late payments in the past, collections, charged off accounts. And usually I would say that's happened because they've had like an event in their life, whether it be job loss or medical, something happened in their past that's still weighing them down today. So that's one thing that we look at to see if there is anything like that and how to repair it and fix it. But then, what I'm about to go into right now, I think repair is very powerful and very strong. It allows us to get to our goal faster. But when it comes to credit building and debt management, to me, I get the most excited around that because we have all the power, right? So if you're someone out there and you're looking at your credit report, there's a few key things that you want to know that you have as a baseline. Number one, you want to make sure you have at least 3 to 5 active, open and good standing revolving accounts. So basically credit cards. 3 to 5 is like that perfect sweet spot. And this is specific to the FICO algorithm. I'm FICO certified. So like that's one great thing about Credilife and what we do. We're all FICO certified, and the algorithm makes up your score. So everything that we're discussing right now is proven. It's essentially guaranteed to improve your score, right? When you do these things correctly. So 3 to 5 is that sweet spot. And when it comes to the 3 to 5 active revolving accounts, there's a perfect ratio that you want to be within when it comes to the reporting balance versus what the credit limit is. And what you want that balance to report on the credit report is to be within 1 to 3% of what the credit limit is. So literally just, if it's $1,000 limit credit card, you want a reporting balance that's within $10 to $30. That's that sweet spot. So that right there, especially when it comes to mortgage financing, when they pull credit for mortgage purposes, that's literally going to put you in the best position to have the highest credit score at that moment in time when they pull credit. That's so important. And around that, this gets brought up a lot, and I think it's important to kind of go through this, is it's not so much when it comes to like when you receive your bill, your credit card bill, like either in the mail or online, it's not about did you pay whatever the balance was on that's billing statement down to 3%. No, what I'm saying is that throughout the course of the month, you only charge like let's say 3% of the limit. So when you receive your bill, that's actually the balance that's reporting on the bill itself, because that bill that you receive, that statement, that's the information that was sent to the credit bureaus. That's actually what shows up on the credit report. And so that's a very important piece, because a lot of times when I talk about this, naturally people think, oh, I get my bill, I'm going to pay it down to 3%. But if you had, let's say, $1,000 limit and you had a balance of $700, and then you paid it down to $30, on your credit report, it will still show a $700 balance out of 1,000, which is a 70% utilization ratio, which lowers your credit score. So I think that's a very important indication that people, I feel like that's something that can really put a lot of power in your hands when it comes to managing your credit. That's one of the biggest ones. And then from there, you really want to look at your credit report and really like the entire data within it. Ultimately, what you want to do is you want to show the ability that you want to have like multiple accounts, different types of accounts. We want to mix, right? So like, do you have a mortgage? Do you have an auto loan? Do you have a student loan? Having an installment account like that is really important, at least one of them. And then you have 3 to 5 credit cards. And even within the 3 to 5, do you have some universal unsecured and maybe some retail? That mix is actually really important. By having a credit mix also boosts up your score. But then also when it comes to lending, when you show that you have multiple accounts open in good standing, you now appear to be able to, when you're applying for something, you want more, right? You want money. I want a loan. Well, based on that credit profile, now you show the ability to repay on that loan in a timely manner. Now the bank feels more comfortable to lend you money. So these are the things that can really put you in a really good position when it comes to your credit profile and your FICO credit score.
Yeah, it's such great information, Jerrad. And I think that, credit scores and how they calculate those can be very confusing, because we get clients all the time that come in and say, I pay off my credit card every month, but their credit score is not spectacular. It's good, but they're doing that where they're charging up. Maybe they just use one card and they charge it all the way up to, 70, 80%. They pay it off every month, but they're not paying it off in the right time. So as it's being reported, it looks like they're constantly carrying this balance of 70 or 80%. So,
Yep.
A big way to easily increase your credit score is how and when you pay your bills.
Yes, that is spot on. And one thing I'd say too, a lot of times what we find working with clients is that when they're using credit cards, they're using them for the perks, right? Like, so cashback rewards, flyer miles, these are things to take advantage of, which I fully support. But what you brought up, Jason, is perfect. It's about the timing. So if you are someone like that, you want to leverage those cashback rewards, then what you do there is you take a look at your billing statement and you want to look at your statement end date or your billing cycle date when that ends. And typically that's roughly like 2 to 3 weeks before your due date is when they generated that and then sent it out to you and gave you time to make that minimum payment, right?
Sure.
That's what you want to look at, is that date. And essentially what you can do, I always say 3 to 5 days before that billing end cycle date, that when they drafted that statement. So 3 to 5 days before that, you can then elect to pay that down to 3%. So still use it, get the cash back, right? But before the statement end date, 3 to 5 days, pay that down, that balance down. Now you controlled the reporting. You now have the power. So you took advantage of the cash back, the rewards, everything. You paid it down before the statement end date. Now you controlled the reporting. Now you're always making sure, there we go. You're always making sure your FICO score is going up. It's high, right? So that's the power of this, you know? And if you're a business owner, this is huge. I mean, it really is, because I would say I've worked with hundreds of business owners, and it is so common for a business owner to use personal credit cards for business purposes. Right. And it's very easy for those balances to go up. They're buying inventory. They're doing all sorts of stuff, right? Well, a couple things happen there. One, as we know, when those ratios are up, credit scores go down, right? We appear to be over leveraged with our credit. But then in addition to that, if they need to access any more capital for business purposes, they now put themselves at a disadvantage by having a lower credit score, which means one, they may get denied, or two, they're not going to pay much. They're going to pay more to get access to that capital. You know, so making these tweaks are important. And if you are a business owner out there here listening to this, the most important thing that you can do there is follow the technique I just laid out, boost up the scores, and then you should be looking at acquiring business credit cards and create that separation from your personal credit to your business. So that way you don't have to worry about this management game. And now you can start funneling all those things for your business under the business. And now you've created that separation, right? So that's a big one. You know, there's so many different ways. That's why I love doing the show with you, is credit impacts everything. We know that. So it's like, there's just so much to this.
Yeah, and I was going to say the phrase that always comes to mind, or that I always say when it comes to credit, is that common sense is not common when it comes to credit. Right? What you think would be good, right? Oh, I got this collection that's been hanging out there for 6 months. I just want to wipe this thing out. As soon as I pay this collection off, my score is going to go up because I got rid of this account. Nope, your score is going to go down by paying that off.
That is a perfect example,
right? I mean, who's gonna think that?
Or if you've got a credit card that you've had opened for 10 plus years, and you're not using it. And so you think, I'm just going to close that. I'm not using it. I'll just close that. That'll help me because then I have, less cards. But what you just did is erase 10 years worth of history. And so you don't want to close that account.
Yeah. One of the biggest misconceptions is that, if I got 5 cards open, man, the bank's going to see that I can get myself in trouble because I can charge, I can max out 5 cards. And so if I close 4 of them and only have 1 card, then I can't get myself in as much trouble. And that's going to look better to the lenders.
Right.
Yep. No, you just closed 4 accounts and you got rid of 4 accounts worth of history, and your score just went down 50 to 60 points because of it.
Yes.
Yep. And I think, the common sense piece that you're talking about, Mike, is so spot on because, naturally when people are, they're motivated for a certain purpose, like I want to buy a home, or I'm looking for a loan, or I'm looking for something, right? They start to look at in their mind, like we're saying, common sense. It's like, oh, if I make these maneuvers, in my mind, that should put me in a better position in the eyes of the bank, so I get approved. And with that, I think a lot of times clients look at their income. They feel like, well, if I have a certain income, or if I have a certain amount of cash in the bank, and don't get me wrong, those are very important factors for what you can qualify for when it comes like loan amount and your ability to the payment amounts. Yep. But your income does not directly impact your score at all. It has nothing to do with your score.
No.
And so that's important, is like, and I feel like because of that, the way people operate is they feel like, okay, well, if I make a certain amount, let's talk about someone's renting right now and they know they want to buy. They're thinking, well, I'm paying $2,500 a month for rent right now in this house for my family. Obviously I make enough money, I can afford this payment. Here I got some credit. I think I want to show that I want to put myself in a better position where I don't appear as risky. So I'm going to close some cards that I don't need anymore. I'm going to pay off some old debt, some collections from my past, because I want to show that I have money now and I'm just going to pay these off, right? That's a good thing. I paid these off. I'm in good standing. But what you just heard Mike talk about is, one, paying off a collection that's reporting lowers your score.
Mhm.
Closing an account that you think might, put you in a bad position in their eyes, closing an open active account in good standing lowers your score.
Mhm.
Now you go and apply, your score's even lower, and you're going, what the heck? And the reality is, your score is what gets you in the door. So if you don't meet the requirements, the income don't matter.
Right.
They're not going to be able to lend to you.
So so true. So true. Mike and I were talking to a client of ours a couple weeks ago, and he wants to buy a year from now, so like next summer of 24, and he's got a car loan. He's got a couple credit cards, two or three maybe. He's got a car loan, so it's an installment loan that's going to be paid off this September. So he doesn't owe much left on it, $1,500 or something, but then that installment loan, it ends and he doesn't have it anymore. So what Mike recommended was, hey, go into the bank, refinance that car loan for another 24 months, because now you've extended it. It's still, the payment's going to be like $15 a month or something, but it's an installment loan that stays in place, which will then help his credit score and put him in a better position next summer.
Yep, that's spot on. That's spot on, because you get a lot of, that's a great point, because once again, naturally you would think as a person, hey, if I just paid off an auto loan, that's a positive, right? I made my payments on time for 5 years. I paid it off. That's a good thing, right? And it is when it comes to the history, but you have to think about when you pay that off and it now closes, there's no positive payment history still happening.
Right.
So now we're missing that active positive data. It's now gone. And if you don't have enough within your credit report, your credit profile, if you don't have enough active accounts, your scores are going to drop. So that's another common sense thing out the window, right? It's like, so
you think pay it off.
Exactly. So it's there really is a lot to this, and I feel that when it comes to like all the information out there, right? We got Credit Karma and CreditWise, Capital One, Discover, and like all these, TV commercials about your credit and your credit score, and work with us because we give you your credit score. The issue is, like, the information out there, it's just, one, there's a lot of it, so people are like inundated with this. Right. And then two, there's no real direction as to what they should be doing when it comes to like their habits around credit. They're just getting scores. And unfortunately, even Credit Karma, which is huge, right? They're massive. And people like Credit Karma because they feel like they can monitor their credit and their profile, and they provide them offers, right? Hey, we feel like you're a match for this card. Well, I hate to break it to you, everyone. Credit Karma makes money when you click on those things. That's how they make money. They're an ultimate affiliate arm. And unfortunately, they even got in trouble for this. Unfortunately, you would think that was specifically tailored for you, but it's not. You're just within a range, a general range, and they're just saying, hey, who's paying us the most right now for this card? Okay, great. Because you're in this range, we're going to present this in front of you as if you're fit. But the reality is people get denied for these accounts all the time. They get hit with the hard inquiry, scores go down, and they're just sitting there like, well, what the heck? I'm on Credit Karma because I want to better understand my credit and improve it. So once again, my point with all this is the fact that you really want to work with a trusted professional that understands FICO, that understands money, that understands credit, and the overall financial wellness of this. Because once you do that and like work with someone like myself and my team at Credilife, the sky is the limit for you, right? So it's just like, that to me is the biggest thing, because then you're getting the information that you need so you can make informed decisions with clarity, and it's going to get you to your goal. So that to me is like the biggest thing. And then we just got Mike.
Oh, we just dropped Jason. Okay, gotcha. Yeah, Jason had to take off. Yeah, I know he had another appointment we had to get going to. Yeah, so the credit thing, I mean, we've gone, obviously, me and you, Jerrad, we have, every time we see each other, we have discussions about this, and it's just, it's true. You got to remember, if you don't know the rules of the game, you're not going to play it correctly. And that's kind of how it comes down to credit. Most people don't know the rules to the game. They don't know how it works. And so to be able to play the game correctly, then it just doesn't happen, but that's why there's professionals like you, me, Jason out there that can help and steer people in the right direction, get them information they need so that we can put them in the best position possible.
Exactly. That's what it's all about, and it's important to know, anyone that's listening is that regardless of where you're at today, there's always a solution, there's always a path. So even if you're someone that has a really low credit score, maybe you've gone through an event in your life and you're just like, oh my goodness, my credit's destroyed. I can't qualify for anything. There's no hope for me. I'm not going to be able to buy a home. Like these are things that people face, and it's very stressful, right? And it can be defeating. But I want you to know that there is a solution. And we work with people like this every single day, and that we help them get into homes every single day across the US. And in addition to that, if you're someone that's kind of like in that middle range and you feel like you're kind of stuck, I've had a lot of clients tell me that's like, hey, I've been working on my credit for a couple of years now and it's hovering around 670 and I'm at a loss. I don't know how to get it higher. So like we help those clients every single day as well on how to strategically boost it so they can get to the 680, 700, 720 plus, right? And so there's so many different services and products and programs that we have available that they are really tailored towards that specific person in their situation. And there's always a solution, and I think that's the most powerful thing to know is that you can achieve your goals. And like, Mike, it's like, there is nothing better. I mean, at least for us and you too, when you have someone that came to you that was in that position and then you referred them over to us and they come back to you for that financing. I mean, the experience for that client, how happy they are, how grateful they are. I mean, it's like literally the doors have opened up to them again in life, right? So like that's what's so fun about doing this.
Yeah, we had two clients come to mind. One, a recent client just a few months ago. We ended up closing on their house, and I got a call from them about a week after closing, and he just said, I got to thank you for what you did for me. He's like, I honestly thought that I would never own a house in my life. And because I came to you and because you referred me over to Credilife with Jerrad and his team and having them get me in position, we closed on a house. And he's like, it still doesn't seem real to me. Again, this is a week after closing. He's like, it still doesn't seem real to me, but I just want to personally thank you for that.
That's so cool.
That's what we do this for, right? That's why we put in the hours.
Yep. Exactly.
The other scenario is one of the very first clients we worked with together, Jerrad, way back in the day, was a kid that never paid a bill in college. So he came to me and said, look, I know I can't get qualified for a home loan right now to buy a house. And he's like, the reason why I know is because I went to college for 4 years and I didn't pay one single bill. Every single bill that he got in college, he put into a shoebox, and he showed up in my office with this shoebox full of bills that he hasn't paid. Right. And I said, okay, well, you've come to the right place, right? You got to start somewhere, and this is where we're starting.
Yep.
So 14 months later, he was in position. We got him pre-approved to buy a house, and he ended up buying a house. So you take someone who didn't pay a bill for 4 years straight and just put them all in a shoebox and just, forgot about them. We got him in position. We got him into a house, 14 months after they had started with us.
Yep. That's awesome. Yeah. And even just recently too, I know we referred over someone that's doing a refinance. One of our clients, I know Rick on my team, one of the senior coaches, had referred someone over to you. And that client, we've been working with her. And when we first started with her, this was a few years ago, we helped her get into a home. So she was able to qualify for a home. She got into that home. And then she's also a business owner and she has equity. And so, now she's able to leverage that equity specifically to kind of help her with her business and all that. So I know she's working with you, but that's just another example of like how powerful this really can be, like when you get in a position to be able to take advantage of these opportunities, I just think naturally your overall like wealth building, your stability, your overall financial stability, like you just ultimately have more options when you get into this game, right? It's a lot better. It's a lot easier once you get into that to be able to do certain things. Because if you're stuck like in that, poor credit range, I mean, think about it. You naturally pay more for insurance. So your insurance rates are higher in most states. You're paying more if you do have any sort of debts, you're going to pay more for it, right? So interest rates and terms and payments are higher. And it's not uncommon that when someone is in that position based on their income, because they are kind of always like that paycheck to paycheck, right? And they're paying more for things and they're trying to manage it. In addition to that, and this is outside of credit, it's not uncommon for those type of clients to also have banking issues, right? They might have some overdrafts and like they're always trying to like manage their money to get past this. And so we help a lot of clients like that as well, because ultimately when we're able to get a better sense of your starting point and where you're at, being able to improve your credit to get access to, one, save money. That's a big one. You get to experience the savings of better credit. The insurance side can actually be huge for people. We've sometimes seen people save $100 a month alone just on auto insurance with a better credit score. But then they're also able now to strategically leverage credit in a way that they couldn't before. They're paying less for it. Now it's easier to manage their funds, right? So they don't have those issues of dipping below and paying those fees. So these are some things that you can kind of get back on track, because if you don't do that, you just get stuck in this wheel, right? And it's like you feel like you can't get out of it, and you're like, how am I ever going to get out of this? Like, I can't even like manage my debts, right? So there's just so much to this, and I feel like, once again, like, regardless of where you're at, there's a solution, and it requires work. You got to double down and work with us. Like, you're going to have to take some actions, but
Right.
outside of that, you just got to take that leap basically and just get started.
Yep. All right. I want to shift gears just a little bit here, and Evan, I want to bring you on too, because I got to get your opinions on here.
Yes.
So the news, right? The news grabbed some mortgage. The media, I should say, grabbed the latest mortgage news that came out, and I want to get your thoughts on, as a consumer, right?
Sure.
As a consumer, what you guys see on the news. What comes to your mind? What do you think happened? So the news said, Biden has some sort of plan for loan level pricing adjustments where higher credit borrowers are going to be paying for lower credit borrowers. To you guys, what does that mean?
I have no idea. I mean, that's what it boils down to. There's not enough information there in a news story to really draw any conclusions about any of it.
Jerrad, you?
For me, I've thought a lot about this. I've done some research on it. I think for most people, when they hear that, they're shocked. Like, what? I have good credit not to pay more for things. Like, that's how they're taking it, right? And I completely agree. I mean, that is backwards as to how this whole system typically works.
Right.
But ultimately, I think there's a misconception that people with worse credit, let's say, all of a sudden are like paying less for everything. It's easier. The reality is the overall costs associated to those loans, yes, are reduced, but the actual cost of those loans in general with poor credit still are more compared to someone with better credit, right? So like, the underwriting, certain things are still there, but they are making a shift. I think what they've done is they've tried to make a shift to kind of extend the cost both ways, so that I don't know the purpose of that. They might see something that I don't, as to how that could benefit the economy, which I don't necessarily agree with, because the reality is it's proven that people with better credit actually have the primary share of all mortgage transactions. So I think they're trying to shift some of that money down somehow to make it where people they pay more, and then try to open up this bucket to hopefully increase more transactions. I think that's what they're trying to do, but that's my interpretation.
Yeah. I'm thinking the general public, I just wanted to kind of get the thought. I think the general public sees that and says, well, it kind of like NFL teams, if you're at the bottom of the NFL rankings, right? Do you botch the last couple games on purpose so you get a higher draft pick, right?
Oh, yeah.
Right? It's like, so
Yeah.
so one of the questions that came in was, I'm seeing the news about this new rate adjustment thing that the government has in place. Should I be taking my credit score on purpose so I get a lower interest rate?
Oh my goodness. Yep. I could totally see that. Yep.
And the answer absolutely is no.
Yeah,
right?
exactly.
The answer is absolutely no. Do not purposely take your credit thinking you're going to get a lower interest rate. The higher credit borrowers are still going to get a lower rate than the lower credit borrowers. So that's the very first thing to take away from this, is that don't ever tank your credit on purpose for anything. There is no advantage. There's no benefit to doing that.
Yep.
What's happening is this how I explain it. So let's say everyone starts at a base rate. And these numbers that I'm going to say next are not the actual numbers. This is just for informational, right? Example purposes only. So let's say everyone starts at a 5% interest rate, right? That's the floor rate. Now, based on your borrowing profile, your credit score, your down payment, your this, your that, there's adjustments to that rate. So let's say everyone starts at 5%. And if you have a credit score that's 780 or higher, the adjustment to the rate is a quarter, right? So now you're at 5.25 for your rate. Well, now with the 680 credit score, that adjustment is, let's say, 3/4. Okay. So now the 800 credit score borrower is at 5.25, and the 680 credit score borrower is now at 5.75. So 5.75. Okay. So now let's say they each have 5% down. Okay, so that 5% down adjustment for the 800 borrower, let's say now is another quarter. So now they're at 5.5. Well, the 5% down for a 680 credit score borrower, let's say it's another 3 quarters, right? So now they're up to 6.5. So that 800 credit score borrower is at 5.5 for their end rate, and the 680 credit score borrower is at 6.5. Okay, so that's what the old basically system worked.
Yep.
While what's happening is that 800 credit score borrower, for having an 800 credit score, now they're going to raise it up 0.5% instead of 1/4. And for the 680 borrower, instead of raising it up 3/4, they're only going to raise it 0.5%. So now the adjustment is the same for those two. And now let's say for 5% down for that 800 credit score borrower, let's say it used to be a 1/4 hit, but now it's another 0.5% hit. So now they're up to 6%. Well, now the 5% down for the 680 borrower used to be 1, but maybe they backed it down to 3/4 now. So the 800 credit score borrower is ending at 6%, and the 680 borrower is ending at like 6.25. So what they're trying to shift some of these adjustments so that the higher credit borrowers pay more and the lower credit borrowers pay less, and they're trying to squeeze those rates together so that the interest rate difference at the end of the day between the two borrowing classes is less, right? Is less than what it used to be before.
Yeah, you're spot on. And I think too, with the message in the media, what you just said is like the only thing that's really being pushed. Good credit pays more, bad credit pays less. So like, that's why people are thinking like, oh, well then should I have worse credit so I can get a better rate? And that's not how it works. Like you just explained, right? But the way that media is positioning this with like just snippets, people only see certain statements that are now leading them to believe like, wait, what am I supposed to be doing here? Right? Like, why am I being penalized? So yeah, it's crazy.
Yeah. Don't go out and buy 2 jet skis and don't make any payments on them. That's don't do that. Right. So, so follow the advice, obviously, of Jerrad and his team and what we've been talking about on these shows of, make your payments on time, keep your credit card balances low, all that stuff. It's definitely still better to have a higher credit score. You're still going to net out with a lower interest rate than if you have a lower credit score.
Yeah. I mean, I'd be curious, for you, like what's your interpretation, at least when it comes to like why they made that move? Like, what benefits do you feel that they're anticipating by doing something like this?
They're thinking that by doing this, they'll get more lower credit score borrowers into homes, and that's their goal, right? The unfortunate side effect of this is that in order to do that, the money's got to come from somewhere. Someone's got to pay for it, right? It's just like income taxes. You take a higher percentage from the higher income earners to help offset the lower percentage that you're getting from the lower income earners. And, that's how you're paying it. You're subsidizing it. That's what a lot of people are calling it. It's like basically an interest rate subsidy so that lower credit score borrowers have lower interest rates so that it makes it easier for them to get into the home ownership game.
Yeah, because ultimately that impacts their overall buying power, so like, because as we know, like when someone goes into it with subpar credit, because they are paying, higher fees, higher interest, and a lot of times the mortgage insurance is also higher. That impacts the amount that they're approved for, right? So it's like it impacts their buying power. So like what you just said there makes sense. It's almost like they're trying to make it a little bit easier for people in that bucket, let's say, and increase their overall buying power. Because the reality is the cost, the pricing of homes they're still up there. It's still a very competitive market. And because of that, like, maybe that's their adjustment that they're looking to do is like trying to see if they can get these people in this bucket to be able to get approved for more, so that way they still have more mortgage transactions happening across the U.S.
Maybe they should, instead of doing that, maybe they should just give free enrollment into your program for the lower credit score borrowers so that they can learn the habits, right? This is one of those things where it's like give a kid a fish, feed him for a day, teach a kid how to fish, feed him for a lifetime.
Yep.
Right? You're just giving a kid a fish right now. That's all you're doing. It's a short term, giving a kid a fish. You're not creating any better habits. You're not creating better homeowners. You're not creating better borrowers. You're just putting a Band-Aid on it. How about take this, how about taking this money, right, that they're going to get, the additional money they're going to get, and offering services like Credilife offers, help subsidize the payment, the enrollment to get into those programs. So now that we can teach them the habits, get them the information they need, because not only will they be better borrowers at that point, they're going to be better homeowners because they're going to have the better habits and know how to manage their money better.
Yeah, you're spot on. I think that's quite common, not in any way to make this political at all, but I think a lot of times naturally in big business or politics, certain things, a lot of times people will allocate funds to solve a problem, right? They feel like, hey, if I put more money over here, that's going to fix it. But what you just said is spot on. The reality is, it's really about identifying the root cause and then developing a solution around that. And a lot of times, it's education, it's empowerment, it's like getting down right in the street, so to speak, where it's like, let's work with people for real, so that way we can instill in them the better habits, give them more education, so they have more awareness. Because it's just like you said too, when someone gets into a home, one, they have to qualify and get into it. But when you have better credit habits, I mean, what are you going to do if you don't have those habits and all of a sudden your AC unit breaks or you have some sort of major, home thing that wasn't covered? If you don't have the financial habits in place, those type of events can cripple you. You know what I mean? Like, what happens if your vehicle breaks down and you don't have credit to get it fixed, right? So there's a lot of things that the more that we can empower people to understand money management and credit and lending, piecing that all together just ultimately puts them in a better position for the long term. So I totally agree with you on that.
Yeah. Definitely easier said than done, no doubt about it. But
yeah,
but I think there's something there. You know what I mean?
Yep.
It's not, money problems throwing money at a money problem doesn't fix it. Money does not fix money problems. It just doesn't. So I think there's a different way to do it. This is a short-term Band-Aid deal. If in my honest opinion, like it can't last. It shouldn't last, right? It shouldn't last to be the answer to creating more home ownership with people in certain credit score buckets or down payment buckets, the different buckets that are out there.
Yep.
Come up with a more permanent solution. And you know what? Not everyone's meant to be a homeowner. That's the other thing here too. It would be great if everyone could be a homeowner. Not everyone is meant to be like that. The people, offering maybe a free enrollment into some sort of program like this, an education piece, you'll separate from those who want to do it and those who want to work at doing it and become successful homeowners versus those who don't. And the people who will put the time and the effort into it, just like your program, they will have to put some work in it. The time and effort that they put into it, they'll be rewarded for it at the end. And then you really know who's serious about it and who's going to put the effort into it.
Yeah, exactly. That's spot on. Yeah, it's a lot of interesting stuff happening right now, and that interest rate change, based on credit score, is a big one, as we know. I mean, it's all over the media like crazy. And I know that you actually addressed this on one of your podcasts about a month ago.
Yep.
But it wasn't on the media yet like it is now. You know what I mean? So I think people now are going, wait a minute, what? And they're like, what's going on? So yeah, it's for anyone listening, you got to go back and listen to that one, because I know Mike did like a full breakdown of like everything with the numbers and all that. So it was a really good show.
Yep. And I shared the actual spreadsheet of comparing the old adjustments versus the new adjustments. I even color coded it. Green is good, yellow, no change, red is a bad change, a higher fee and stuff like that. I try to make it easy for Walgrave to follow it,
Exactly.
So I put colors into it and I drew some pictures on it to keep them engaged with it. So yeah, it's really good.
We got to keep it easy for him so he maintains that healthful, youthful look that he's got going
right?
on. You know what I mean?
Yeah, we can't have it be all confusing and stressful for him.
Exactly. He's not even out here to defend himself.
I know, that's the best part.
See this later and he'll be like, oh my goodness.
That's why I love it. Well, Jerrad, definitely appreciate you being on the show today. Always good to have you on. And as our show comes to an end this week, we definitely want to thank everyone for tuning in live or catching the podcast at a later time. You can find us anywhere, wherever you find your podcasts, and on our website, ushometalk.com. We're here to help with all of your real estate and financing needs here in Minnesota, South Dakota, and in the entire United States. I'm Mike Overson with Illuminate Home Loans. We're going to be signing off here. Have a great week, everybody.